Welcome back, financial strategists. We've made incredible progress. You've saved your first 5,000, you've protected it in your financial first aid kit, and you've bravely stepped into the world of investing, understanding that market dips are actually opportunities. You're building your asset column, but as you start to invest, a new vital question emerges. How do I protect what I'm building, and how do I make sure it's growing as effectively as possible? Today, we're diving into two sophisticated, yet absolutely essential concepts that every serious investor must master: diversification and asset allocation. These aren't just fancy terms, they are your shields and your accelerators, crucial for navigating the financial landscape of 2026 and beyond. Let me take you back to my early days in the business industry, before I had my advanced accounting experience. When I was still learning some tough lessons, I got involved with a friend's new venture, a small tech startup in South Wales developing a niche app. I was excited, I saw the potential, and I put a significant chunk of my early savings into it. I mean, all my eggs were in that one basket. Now, thankfully, that particular venture eventually did quite well, but for years I lived with an agonizing knot in my stomach. Every hiccup, every missed deadline, every sign of a competitor sent me into a spiral of worry. I was undiversified, holding essentially one single risky asset. Looking back, it was incredibly naive. Had that business failed, which many startups do, I would have been financially devastated. This story, though it had a happy ending, taught me the hard way about concentration risk, putting all your hope on one outcome. It's a mistake I see echoed in personal portfolios today, whether it's having too much in one company stock or relying solely on a single type of investment. So let's start with diversification. The old adage, "Don't put all your eggs in one basket," is not just a saying, it's a fundamental investment principle. Diversification means spreading your investments across different assets to minimize risk. Why is this so powerful? Because different investments perform differently at different times. When one area of the market is down, another might be up, or at least stable, buffering your overall portfolio. Think about it like this: different companies. Instead of just Apple, you own Apple, Google, Microsoft, and thousands of others through an index fund. If Apple has a bad quarter, it won't sink your ship. Different industries, technology, healthcare, energy, consumer goods. A downturn in one doesn't cripple your entire portfolio. Different geographies. The US market, the UK market, emerging markets. Economic struggles in one region don't mean struggles everywhere. Different asset classes. This is where we transition to asset allocation. Key takeaway for 2026: diversification is your primary defense against unforeseen economic shifts. It smooths out the inevitable bumps in the market and protects your wealth from specific company or sector collapses. Question for you. Looking at your current savings or early investments, are all your eggs in one type of basket, or are you already diversified across different types of investments? Share your thoughts below. Now, once you understand why to diversify, the next step is asset allocation. This is the art and science of deciding how much of your money goes into which types of assets based on your age, financial goals, and comfort with risk. It's your personal investment recipe. The main asset classes we typically consider are equities, stocks. These represent ownership in companies. They offer the highest potential for long-term growth, but also come with the most volatility. Think of index funds that track the FTSE 100 or S&P 500. Fixed income, bonds. These are essentially loans to governments or corporations. They are generally less volatile than stocks and provide a more predictable income stream, but offer lower growth potential. Cash equivalents. Your emergency fund, high-yield savings, very stable but low growth and vulnerable to inflation. Real estate, direct or REITs. Investing in physical property or real estate investment trusts. The right allocation isn't universal. A 25-year-old in London saving for retirement might have 80% in stocks and 20% in bonds because they have decades to ride out market swings. A 55-year-old in California nearing retirement might shift to 60% stocks, 40% bonds, or even more conservative, to protect their accumulated capital. Your asset allocation should change as your life circumstances and goals change. If you're starting to see how these strategies give you genuine control over your financial future, please hit that like button. Your support helps this vital information reach more aspiring investors. And if you're ready to master these powerful concepts and build truly resilient wealth, subscribe to the channel and hit that notification bell. We're on a mission to empower smart financial decisions. Share this video with someone who might be overwhelmed by the market. Let's simplify and strategize together. So, how do you apply this today in late 2025 as we look ahead to 2026? Review your current holdings. Look at your investments. Are they concentrated in just one company or a few funds that are all very similar? Define your risk tolerance. Be honest with yourself. How much fluctuation can you genuinely stomach without panic selling? If a 20% drop would make you lose sleep for weeks, you might need more bonds. Consider your time horizon. When do you need this money? Longer horizons allow for more risk, more stocks. Shorter horizons demand more safety, more bonds, cash. Simplicity is key. You don't need dozens of different funds. For most, 2 to 3 broad, low-cost index funds that cover global stocks and global bonds will provide excellent diversification and allow for easy asset allocation adjustments. For example, a global equity index fund and a global bond index fund. Your percentage split between these two will be your asset allocation. Rebalance. Periodically. Over time, your allocation will drift. If stocks perform well, they might become 85% of your portfolio when you aimed for 80%. Rebalancing means occasionally selling a bit of what has done well and buying more of what has lagged, bringing you back to your target allocation. This forces you to sell high and buy low automatically. This is your custom recipe for managing risk and maximizing long-term returns, built to suit your life and your goals. Another question for your growth. What percentage of stocks versus bonds feels right for your current stage of life and financial goals? Think about it. In the world of corporate finance, we rigorously analyze risk and allocate capital across diverse projects to ensure stability and growth. Your personal portfolio deserves no less rigor. My years in advanced accounting have shown me that the difference between merely saving and truly building wealth lies in these strategic decisions. They are your financial architecture. You now have the framework to diversify your investments and strategically allocate your assets, setting yourself up for a far more robust financial future in 2026 and beyond. But what about the tools to make these strategic decisions easier? In our next video, we're going to explore the power of automation, setting up your portfolio to run on autopilot. We'll dive into how to set up automatic investments and rebalancing to make investing effortless. You won't want to miss it, so stay tuned for that video popping up on your screen. Thank you for continuing this vital journey with me. I'll see you in the next one.